The government has tried to make it more difficult for Elon Musk and Tesla to compete against the legacy automakers by denying Tesla's Model Y a valuable $7,500 EV tax credits. They didn't classify Model Y as an SUV, which meant pricing needed to be much lower to gain access to the credit. However, this oversight has backfired as Elon Musk has taken matters into his own hands and put Tesla back in control of its destiny with the most aggressive pricing cuts the company has ever seen across all models, now enabling the most affordable Tesla, the standard range Model 3, to start at $36,500, and the Model Y long range to start at just $45,500, now that its price is within range of receiving the incentives in the United States. The initial reaction when Tesla cuts prices is always to sell the stock, because this means less margin for the company, translating into less profit. But this time seems to be a little different, as reality may be setting in for some investors. The day after Elon Musk took prices down, Tesla stock indeed opened much lower, down over 5%. But by the end of the day, the stock was surprisingly barely down less than 1%, even though this move undeniably will affect Tesla's profits. But what was even more interesting is how Tesla's competitors felt the pressure on their own stocks. Of the three major US automakers, General Motors fell 4.75%, Ford down over 5.2%, and Stellantis down 3.8%. Keep in mind that the broader stock market indices were all up that day, making this more of a bloodbath than it seems. Toyota and Volkswagen, which also have major US businesses and compete against Tesla globally, were both down 1.45% and 2.8% respectively. It appears that some of the shareholders of these companies may have actually gotten worried and believe that Elon Musk's strategic chess move may actually affect sales at these entrenched automakers that rely mainly on ICE vehicle sales. The top 10 automakers are responsible for roughly 50% of the world's auto sales, yet overnight Elon Musk's decision has somehow poked each one of these companies in the eye. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and a brand new set of financial data going back 15 years, and it's all freely available. Let's look at why legacy automaker shareholders freaked out after Tesla's EV price cuts by turning to Ford's financial statements as an example. In 2020, Ford's revenues dipped dramatically, but this has lasted for a few years, longer than people expected. But now looking at the trailing 12 months, revenues are back to where they were in 2019. But hang on a second, how is this possible if Ford's unit sales, their vehicle deliveries, have continued to drop over the years and have not yet recovered? And this is also true for virtually all of the aforementioned automakers. The reason is because they've been able to drastically increase prices since supply is so tight across the industry. Vehicles are necessities for many, and since supply chains have been thrown out of whack and production is down, people are willing to pay more to get a car and to get it as soon as possible. So Elon Musk has decided to gambit away short-term margins and profits at Tesla in order to exploit this weakness that all of the automakers are taking advantage of. He's attacking head-on these high prices, which is keeping the industry afloat. Tesla can do this because of all the automakers, they haven't seen a decline in volumes. They're one of the few to have seen an increase, over 40% in 2022. The 1-2 punch setup for this was in the works in the middle of last year, starting with Elon Musk's note saying, "We are trying to reduce delivery times as quickly as possible. Long wait times are not a good thing." This was when it was taking 6 months to a year in order to deliver a Tesla. Since then, Tesla has been able to cut through supply chain issues and greatly reduce wait times to just a few weeks. The stock market misinterpreted this move as a terrible sign, since making it quick and easy to get a Tesla makes investors believe that there is a lack of demand. But in fact, it makes a good customer experience. For everyone else, it still takes months, if not literally years, to get a car, so they can't keep up with their own demand. But in reality, they are having production problems leading to declining sales, meaning they need to raise prices on customers, overall creating a painful and frustrating customer experience. The second blow was the recent drop in prices. You don't drop your price by $20,000 in one day if you're having demand issues. For demand, you would lower it carefully to see where demand picks up in order to keep margins high. You drop your prices $20,000 in one day if you want to surprise your competitors and catch them off guard. Many believe they'd have an easy time without Tesla's best-selling Model Y getting the tax credits since it was excluded. Now, not only is it getting the tax credits, but Tesla also slashed prices even further. So now affordable Teslas are readily available basically right away compared to now expensive and obsolete gas cars for which delivery dates are up in the air. For the first time, Tesla's electric vehicles are now unmistakably cheaper on sticker price than gas cars, since competitors are raising prices right into Tesla's reduction of prices. The average price of a car in the United States is now $49,500, which means Model Y and Model 3 now start at $4,000 and $13,000 cheaper respectively below the average car. When a disruption like this occurs that people really haven't seen before, they resort back to what they believe is tried and true. For instance, the automakers have been around forever, they'll figure it out, and they'll recover. But this leads to people making the wrong decisions at the worst time. For instance, upon hearing the news of the price cuts, Jim Cramer tweeted that the competition is here, indicating that Tesla had to cut prices because they've run out of demand. But in reality, as Tesla scales to hit a larger market, price simply has to be cut in order to achieve this. When Tesla goes from 1 million to 2 million cars, there's simply no market at that size to keep selling $65,000 cars into. That's a luxury price. But as price goes down, the addressable market size drastically increases. According to ARK Invest 2021 data, at a $65,000 price, Tesla has access to roughly 5% of the overall car market. But at $45,000, the market size triples to about 15%, which is what Model Y would now be targeting. At $35,000, which is closer to the Model 3's new price, Tesla can now access about 25% of the market, bringing in a huge number of new buyers. But the ICE vehicles have never had competition from Tesla in this market segment before. This is a big problem for automakers because if their sales continue to fall, they will need to raise prices even further to make up for it, thus making their vehicles even more unattractive, and the vicious cycle continues. And so Jim Cramer is right, competition is here, but not for Tesla, rather from Tesla. And it gets even worse for legacy auto. See, Tesla is frequently compared to Apple, vertical integration, premium product, iPad on wheels, etc. But Tesla doesn't want to just focus on the high-end market. Their mission of transitioning the world to sustainable energy is much broader than this. Tesla needs to be in all major market segments to make this happen. And so Elon Musk's price-cutting move looks more like a page from none other than Amazon's playbook. When Amazon enters a new market, they drive down prices and squeeze competitors in order to take up market share. Amazon has some big advantages, including their technology platform, which can adapt quickly to new market segments, and they have massive scale and resources to undercut competitors while offering a more convenient service. Amazon also cares more about growth and market share than they do about near-term profits. For many years, investors were upset with Amazon because they never turned a profit and traded at over 1,000 times earnings as they spent all of the money they made on new opportunities. This led to huge revenue growth in the meantime, and eventually, Amazon would demonstrate here and there its massive earnings power. But while Amazon is busy taking share, many people get confused, see a high PE ratio or lack of profits, thinking that Amazon has lost its way, only to be proven wrong later. At Tesla, Elon Musk has been investing in new batteries and manufacturing techniques, further vertically integrating, adding more automation, refining their gigafactories, and removing parts from vehicles to simplify and reduce cost. This platform that Tesla has built will allow them to sacrifice short-term margins without getting hurt as much as the damage that they will deal to automakers. Tesla has the opportunity to come out even stronger, giving it a huge advantage in the long run. Currently, the traditional automakers on the surface are more profitable than ever, but below the surface they are already struggling. Every automaker loses money on every electric vehicle they sell. It's obvious with companies like Rivian or Lucid, which don't have gas car businesses to mask these losses. But all major automakers don't have enough volume to be profitable on EVs, which is why they've been half-heartedly in this race, preferring to push gas cars instead of EVs, the latter also requiring less maintenance and therefore less future revenue. In addition to that, there have been supply chain issues plaguing industry production, as previously mentioned, hence the price increases across the industry. But just in the last few months, interest rates have skyrocketed, putting even more pressure on demand for everyone because this makes financing far less affordable. Elon Musk is predicting a recession this year, which historically has made it even more challenging to sell cars. Now throw in Tesla's price cuts, which are meaningful now that Tesla has a run rate near 2 million vehicles per year and growing. This could be enough to push some competitors over the edge. Basically, they're amplifying the already difficult auto environment, but for everyone else. And this trend is just getting started. Tesla has made vast improvements over the years to its platforms, which are just beginning to pay off, and yet even after these price cuts, prices are still higher than they were about a year and a half ago. So Tesla's prices could still fall even further if commodities take a hit. Typically, as the saying goes, commodities go up like an elevator and down like an escalator, especially during a recession. There are also US tax credits for battery production, which is immensely beneficial to Tesla, which already makes and is ramping battery production in the US. So Tesla is well positioned. Now, Elon Musk is quoted for saying that Ford may not survive the next recession, and Tesla is pushing a little bit harder than usual this time around to help make that happen. The US automakers make a living off of their pickup truck divisions in the United States, but their biggest threat, the Cybertruck, is coming out this year, adding to the chaos. If that's not enough, Tesla appears to be on the precipice of introducing a lower-priced vehicle in the $25,000 range in 2024, which seems much more likely to be achievable at that price point now that the Model 3 starts at $36,000. This would allow Tesla to further delve into all major vehicle segments where ICE has little to no EV competition today. So far, Elon Musk has taken two major important steps for Tesla, both viewed negatively by the market. But the next few years will be critical as electric vehicle market share grows exponentially to replace the internal combustion engine market. The Tesla bulls have been forecasting the demise of traditional auto, and the bears continue to predict the demise of Tesla. But as the current and future economic conditions become more challenging, the true state of the market will become clearer. So do you think electric vehicle demand will be a problem for Tesla over the next 3 to 5 years? And what, if anything, will cause either Tesla or traditional auto to falter such that it's no longer ambiguous as to who has brought the competition? Don't forget to watch my video on how subprime financing could collapse the auto industry. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.